Coming up on Market to Market, the U.S. looks for trade options in a global landscape. The devaluation of the peso's impact on American producers. A look at USDA's effort to increase the practice of double cropping. And commodity market analysis with Dan Hueber next.
What's next doesn't happen by chance. It happens when researchers and farmers work together to solve tomorrow's agronomic challenges. We're committed to creating what's next, because a pioneer, our name is our mission.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
This is the Friday, December 15th edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. Volatility in government reports has been replaced by more moderate movement of the economic snapshots. The Consumer Price Index moved higher by 0.1% last month. The core reading without food and energy gained 0.3%. The wholesale price mark, the Producer Price Index, was flat in November after falling in October. Retail sales added another month of gains, this time by 0.3%. The Federal Reserve kept its key interest rate unchanged for the third consecutive month, even signaling 3 cuts of 0.25 point each in 2024. The Department of Energy gave the renewable fuel industry a boost late this week, providing clarity for the Sustainable Aviation Fuel Credit, embracing the GREET protocol. The expansion of fuel qualifying under the RFS program includes biomass-based diesel, along with advanced and cellulosic biofuels. A series of trade reports also delivered good news to American producers in another outlet for products. David Miller looks at some of the numbers and trends in trade.
According to a recently released study by the Peterson Institute for International Economics, American engagement in the world economy has likely added 11% to the U.S. gross domestic product. Researchers with the independent nonprofit Nonpartisan Organization say U.S. GDP would have been nearly $2 trillion below the $25.5 trillion mark recorded in 2022 without the country participating in global trade. The report also shows inflation between 2016 and 2022 as the main driver of the higher payoff. The white paper does show that trade barriers have contributed to an overall slowdown in trade as globalization has tapped the brakes. Over the past decade, countries like China have experienced a declining ratio of two-way trade to GDP, while the U.S. ratio has been flat. The report claims that more than 310,000 manufacturing jobs were adversely affected by increased imports of manufactured goods. 2/3 of those jobs were in the manufacturing sector, with the rest mainly in support services, though agriculture and mining were also affected. Other downsides in the data included an estimated 2.4 million domestic workers who lost their jobs due to Chinese imports between 2000 and 2011. Peterson Institute researchers say this is a small number when compared to a U.S. workforce of over 50 million. U.S. trade with China continues to suffer ups and downs. Earlier this week, a conflict over new phones produced by Chinese telecom giant Huawei Technologies brought strong language from both sides of the Pacific. Commerce Secretary Gina Raimondo warned of the strongest possible action to defend national security. The Chinese Foreign Ministry responded in kind. The U.S. has repeatedly said that it has no intention of decoupling from China or obstructing China's economic development. It should put these commitments into practice. China will follow closely the developments of the situation and resolutely safeguard its legitimate rights and interests. China's Permanent Normal Trade Relations Status, or PNTR, has come under federal scrutiny. Various farm advocacy groups are concerned the U.S. Select Committee on the Chinese Communist Party might recommend revoking China's PNTR. In a letter sent this week by Farmers for Free Trade, a case was made for keeping China's PNTR status. They believe removal of the status that smooths out the bumps in the trade policy road will have a profound economic effect on America's farmers, ranchers, and food producers that will be felt for years. The letter goes on to state that China is the largest buyer of U.S. food and agricultural products, and continued purchase of these products by China is critical to America's farmers and rural communities. Among the groups also signing the letter were the American Soybean Association, the National Corn Growers, and the Meat Institute. For Market to Market, I'm David Miller.
Farmers have a history of looking for new ways to improve how to produce food and fiber. Conserving resources and stretching dollars is nothing new. But having one crop that can be utilized in various ways is part of the attraction to cover crops. Colleen Bradford-Krantz reports in our cover story.
When Russian forces invaded Ukraine in 2022, USDA worried about the possible impact on the global food supply and on already high food prices. As response plans were being formulated, the Risk Management Agency, the USDA unit that handles crop insurance, announced a plan it hoped would boost production inside the U.S. to offset any losses in the former Soviet Union's breadbasket. They expanded and simplified 2023 insurance coverage for acres that were either double cropped, where one crop follows another in the same field in the same year, or relay cropped, where the two crops overlap.
We expanded double cropping coverage into 1,500 additional counties. The expansion in 23 was historic, in my opinion. Farmers answered the call. Crop insurance agents did a lot of educating to farmers about what this was going to look like. Crop insurance companies supported it, and RMA processed, as a result, 4,166 new requests for coverage in states where insurance for double cropping was expanded or made easier.
While the Southeast and the Northeast have traditionally had more acres double cropped, traditionally hovering around 8%, other regions, including the Northern Plains and the Midwest, lagged behind, usually below 2%. Some farmers still aren't eligible for double crop coverage, while others must continue to document 3 years' worth of the practice before being considered. But the boundaries expansions made more producers eligible for the insurance, the cost of which is split between the farmer and taxpayers.
In states where double cropping coverage was expanded or made easier, nearly 1 million additional acres of grain sorghum and soybeans were insured, representing more than a 48% increase in insurance coverage for the second crop compared to the 2014 through 2022 average.
RMA focused on second crop soybeans and sorghum, which have short enough growing seasons to be planted after the winter wheat harvest. RMA Administrator Marcia Bunger, who farms with her husband in South Dakota, has been happy with the results so far and expects additional federal expansions to the program.
It's such a new concept, probably in those areas that it got expanded to, that without the protection of crop insurance, it would have probably taken a number of years to evolve. Because we don't have a crystal ball for weather, you need to be somewhat cautious because it costs money to put crop in the ground. Farmers felt they could sleep at night probably a little bit better.
The extra acres may have been planted due to RMA simply providing farmers with a safety net, but other factors were also likely at play. Dry weather last year in some Midwestern states may have harmed winter wheat and forage harvests, prompting some farmers to put in a subsequent crop. Other producers likely added wheat to their operations as predictions of higher futures prices came in the wake of the invasion.
So insured winter wheat acres were up over 2.5 million acres, and that is a 16.8% increase in the area where USDA streamlined the coverage.
Linus Rothermick, who farms about 100 miles west of St. Louis, was double cropping before the federal program was expanded, but has not added the double crop coverage just yet. He follows wheat or rye with Japanese millet, the seeds of which are planted by other producers who use it for hay.
Here in Missouri, we will grow, if we grow wheat or my rye and stuff is harvested in July, late June, early July. So this was planted in the middle of July and it's already almost close to being mature. So it's a really short season crop. So I can squeeze this in as a double crop, and that's where it really, really works for me.
Still, he stands by double cropping as a good practice, both for soil health and his bottom line.
Because I'm raising two crops, I got to raise a really, really good corn crop to be as profitable as this is.
More than 300 miles to the north, near Latimer, Iowa, Plaggy Farms Incorporated has been experimenting with double and relay cropping for 4 years. The family has planted soybeans following rye in the past, and this year, soybeans following oats. They also experimented with following oats with a sorghum Sudan grass, radish, turnip blend that a neighbor's cattle grazed in the fall.
I don't have a history proven with the USDA yet. They just came out with some new initiatives in the last year or so, expanding double cropping to new counties, and now we'll be eligible for it, so now I want to make sure I certify that I'm doing it.
Plaggy is doubtful they will apply for the insurance anytime soon. He's weighing the benefits against some of the program's restrictions.
Primarily, they love that fruiting body.
There's a lot of restrictions on planting dates and crops that can be planted and how they're planted, which we like to experiment, and we're learning so much every year. It's hard to fall into a program until we have enough experience to do it correctly.
But he will keep an eye out for some of the fine-tuning of the program that Bunger says is coming, and plans to continue double cropping regardless.
Last year, I actually planted crops on our farm here in northern Iowa 9 months out of the year, and we harvested crops 4 months out of the year. So it really spreads out our workload and diversifies our farm significantly, so we're not as exposed to weather risks such as the drought of this year. I think the changes RMA is doing is good. I think it will open up opportunity in the future.
For Market to Market, I'm Colleen Bradford Krantz.
Next, the Market to Market report.
Argentina's change in the peso valuation, along with some improved South American weather forecasts and export buying, influenced the trade. For the week, the nearby wheat contract lost 3 cents, while March corn also shed 3 cents. Argentina's economic sea change and technicals influenced the soy complex. The January contract added 12 cents, and the January meal, it improved 90 cents per ton. March cotton shrank by $1.65 per hundredweight. Over in the dairy parlor, January Class 3 milk futures lost 46 cents. The livestock market was higher. February cattle gained $3.62. January feeders put on $5.60. And the February lean hog contract strengthened by $2.92. In the currency markets, the U.S. dollar index lost 146 ticks. January crude oil added a quarter per barrel. COMEX gold increased by $16 per ounce. And the Goldman Sachs Commodity Index added a little more than a point to settle at 533.45. Joining us now is regular market analyst Dan Hueber. Hi, Dan.
Hi. How are you today?
I'm all right.
Good.
If we wouldn't have had yesterday with export sales, wheat would have had a pretty bum week.
Oh, exactly.
Why were exports, why was the U.S. wheat in such demand?
Well, of course, I mean, you can attribute 75% of those sales yesterday to China, or last week to China. And again, they've been a fairly substantial buyer, really, over the last 2 to 3 weeks as far as U.S. wheat. So, yeah, and I think competitively, we're there in the world. I mean, the U.S. has got the product at this point in time. We're competitive to elsewhere in the globe. You know, of course, there is, Russia now is basically kind of feeding their satellite nations in Africa and places like that. So, I mean, we are the market for the wheat. And like I say, China has been in here taking advantage of that.
Why was China only looking at price and why they were interested in the U.S.?
Oh, and not that there isn't a little bit of goodwill there too, but I mean, yeah, it's been unusual to see them in our wheat market, so I think price still has to be the dominant factor, but there could be a little bit of goodwill thrown in there as well. So, yeah.
We like gifts at this holiday season.
Absolutely.
Are there more gifts to come in wheat?
I think the wheat market is probably of the three, corn, soybeans, wheat. Wheat is the one that's probably got the best looking picture right now, primarily because of the resurgence in the demand. I don't think we're going to get carried away, but I think there is probably one more could be substantial rally between now and the end of the year. So.
Oh, Dan, you have to define substantial now.
Substantial, equal to the one we saw probably 30 days over the last 30 days. So I mean, it's to take us back into let's say Kansas City up towards the $7 mark. I don't think is unreasonable.
Okay. Yep. Corn-wise,
yes.
You're not as optimistic about that commodity.
Why? Corn is, even though there's been fairly reasonable demand sale-wise over the last few weeks. It's certainly not making up for lost time, and we're certainly not shipping it as we should be at this point in time. So I think corn is probably going to get tugged along with what the wheat does. So if wheat does rally, corn's not going to be breaking at that same time, but same token, we're just range bound. I mean, we've been really in this pattern for weeks and weeks and weeks, and I don't really see us coming back out of there for the time being.
A few minutes ago, we mentioned the aviation fuel story. Those types of renewable fuels that didn't really mention corn ethanol in there. But is there success with the cousins going to help corn?
Well, it certainly can't hurt, but no, I think most of the emphasis is going to be on the bean oil and whatever vegetable oil product we can get into that arena. And again, there's where you can see growth down the road. And granted, up to this point in the year, the strength in the bean market has been more concentrated on meal. But realistically, it's because we've got good meal prices everywhere in the globe right at this point in time. So people love our beans, so they can crush them into meal. So ultimately, that leads to an oversupply of meal, and I think we're already have kind of reached that juncture. So if beans have much hope in the future, it's probably going to be oil driven. So.
That's really the only driver of the bean market moving forward.
I think moving forward, correct. Now, granted, we know South America's not made yet. Yes, weather problems could develop there, but we seem to have kind of gotten over the hump on some of the weather issues in South America. And without that, it's going to be pretty difficult to sustain rallies in the bean market for any length of time.
So you're finding plausible information about weather in Brazil to make you think we're sideways?
Soybeans?
Yeah, on soybeans.
Sideways to lower.
Sideways to lower. How much lower? I did want to ask you about that.
Oh, I don't, and again, granted, we have to throw our growing conditions in. It's not going to be that much longer, and we're going to start talking about acreage and weather for the U.S. in this coming year. But without a major upset in South America, from where we stand here today, unless it just turns dramatically worse from here, then I think you're looking at 60, 80 cents more to the downside.
Wow.
I mean, which,
in
the greater scheme of things, that's not huge. I mean, it's, but still.
But it's significant.
Right.
So,
right.
Do I cut my losses and make some sales then before the end of the year?
I personally, I think any rallies you get a bounce, you sell into it. Yeah, I just don't see where we get carried away to the upside of the bean market, so.
Okay, we've danced a little bit around this peso story, but I want to first start with the dollar and a question that came in and what's impacting here. This is from Jerry via X, and he says, with rates falling, will we see strength in commodity prices due to a weaker dollar?
It eliminates some resistance. Let's put it that way. I mean, if the dollar does, and again, the dollar is psychologically broke this week. Certainly. And again, it's been in a down pattern for several weeks. But the extra pressure this week came because of the announcement. Yes, that we're probably going to see some rate cuts next year. I guess I tend to think that more emotional than anything that's realistic. And we're still the best economy in the world. And what I think you're leading into, of course, is now you've got Argentina, who in essence halved their currency in relationship to the dollar. Now, granted, they had a terrible crop last year, didn't get off to a great start this year, although things have improved pretty dramatically over the last several weeks. I mean, they're going to be increasing competition all the time. So people go to the lowest denominator, and it's going to be Argentina if they have the product available.
And that's what we think is likely to happen initially or long term?
Well, I think long term, if And granted, nobody knows exactly how things are going to turn out there, but I mean, that country has suffered for years and years, not just crop production wise, but I mean, the programs of the Peronis for years have just hamstrung that nation. And if it is truly opening up as a freer market, it's probably the remedy they need to kind of get things back on footing. And they have all the potential in the world to really increase production, but have been, again, hamstrung by government policies and export restrictions and that type of thing. And, this could really open up a whole new world. Not that they'll ever necessarily keep pace with Brazil, just because Brazil has the land mass, but, they have some very productive soil. And the technology could improve dramatically, so they'll be a force to reckon with.
Which U.S. commodity will be impacted the most here in the next 6 months to 12 months because of the peso and the changes in Argentina?
Well, of course, their cup of tea has always been bean products, so it's probably going to come in the meal and the oil markets.
Okay.
So, yep.
Cotton. This thing, again, like so many things, tied to a range. We've shrunk the volatility.
Right.
Why?
Well, partially part of the end of the year, partially that we're coming to reality of the world is looking at adequate supplies and really kind of a stagnant demand base on the cotton market. So hard to really say much optimistic about it. In fact, if anything, I'd say we're probably looking at lower prices.
So you're not another pessimistic market outlook?
Another pessimistic market outlook, yes.
Anything save it?
You don't really, even there, you look at Brazil, some of the problems they had with the acreage of soybeans getting planted, that's probably going to shift over to cotton. You might even see a little bit of that in Argentina. So, boy, without a major weather event down there, pretty difficult to think we're going to hold the prices here.
Okay, livestock.
Okay.
We know the headlines. You wrote a lot this week about technicals.
Okay.
But what is dominating in this livestock? Is there another story afloat? Let's start with live cattle first.
Live cattle are, of course, they're a victim of their own success over the last few years. Success meaning high prices. And, you just reached the point, I think the consumer pushed back against it, the export market pushed back against it. And, once you make those changes, they don't reverse easily. Once the consumer starts buying more pork, starts buying more poultry, it's not easy to go back to beef, particularly when you look at the price discrepancy between the two. So, yes, we've probably beat the cattle market down over the last 30 to 60 days far enough that we're due for some recovery. But, unless we can really stimulate the demand at the retail end of it again, recoveries are probably going to be semi-limited.
The holiday period, we kind of do shift our diets to a sense of we eat different things.
Certainly.
Is there any of that at play too?
Well, you would, if anything, it would tend to be hams this time of year, and of course the buying always happens earlier than just the week before Christmas to begin with. But the pork market, has definitely struggled again in the last week. I think the action we saw the last 2 days, I think is definitely encouraging. So I think if there is one market that we could probably look out into the first 2 quarters of 2024 and say we could have some higher prices, it's going to be in the pork.
So if the hog market has this potential, is this just well, I want to see the chart because I'm kind of curious how we ended up with a decent day on Friday,
yes,
but we're still close to that mid-70 range. We're still on the low end of this thing. So
sure.
82 was a good price. Any chance that can come to fruition here in the first half of 24?
Oh, maybe towards the latter half of it. Latter half of the first half, I guess.
Okay.
If you want to define that. So it's which you're probably already out there to a certain extent in the June contract. So, but just from a seasonal standpoint, that is generally a pattern we look at is a little bit higher into spring, summer, and then go through the whole process of the fall again. So.
I want to wrap up livestock with feeders.
Sure.
Because again, that is a market that has. I think you said a victim of its own high prices. Is that the same story there?
It is, and again, psychologically, if we do see corn stagnant and be under pressure, that should keep a certain amount of demand in the feeders. But if feedlots are losing money, it's going to be difficult to really say there's going to be overwhelming amount of demand on the feeder market. So.
Do you subscribe to any outside story of insurance payments or some big client on the wrong side of a trade that's maybe happening here with cattle or feeders?
Well, insurance payments, of course, are just like any other risk management tool. I guess a certain amount of people use them. I've never seen where they have, really embraced the volume and there to make a big market swing. And again, I'm not going to go so far to say it's influencing the market. Again, I come back to the point where I think after the better part of a half of a year of higher into record prices on pork, I think there's where the issue is coming back in fall too. So.
All right, Dan, thank you for your time. We have some more questions for you. We'll get to those in a minute, okay?
My pleasure. Sounds great.
All right, Dan Hueber, thank you very much. And hold it there, please, because we are going to pause this analysis, continue our discussion about these markets in our Market Plus segment. You can find both analysis and plus on our website at markettomarket.org. Our YouTube channel is updated twice a week with our Market Plus, our stories, and the MTOM Show podcast. Follow today and know when we post and be the first to watch our content by heading to youtube.com/market-to-market. Next week, a look at the latest winner of the World Food Prize. Thank you so much for watching. Have a great week.
Market to Market is a production of Iowa PBS, which is solely responsible for its content.
What's next doesn't happen by chance. It happens when researchers and farmers work together to solve tomorrow's agronomic challenges. We're committed to creating what's next, because at Pioneer, our name is our mission.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.